In today's video, I'm going to be breaking down two different ETFs that I have been asked for in the comment section to re-evaluate because, of course, right now, Bitcoin and Ethereum are not exactly doing very well at the time of making this video, or at least planning this video, because apparently it's up like 7% today. So Bitcoin is doing extremely well. Let's get down, let's check these out. Okay, so this is a purpose investment, and we're going to first look at ETHY, E-T-H-Y. They also have two different other options where it's in US funds and also hedged to the Canadian dollar. I mean, non-hedged to the Canadian dollar versus hedged to the Canadian dollar. I personally hold this one. Now you may be wondering at first, okay, 15%, 15%, 19%, that is a crazy yield. Why is it so high? Well, first off, both of these ETFs have an extremely high dividend, and the reason for that is because they're selling covered calls against Ethereum, and then for the next one, BTCY, they're selling covered calls against Bitcoin. So that is why they are able to pay such a high dividend versus just holding the coins outright and not getting paid at all. As we can see here, the 1 year historical price of Ether is pretty crazy. It's ranged from anywhere from just under $2,000 all the way up to about $4,800, and now it's sitting roughly around $3,200. If we zoom in, I'm going to show you something really cool. It had a double bottom, which is potentially why it's going up. There's also many other things in the world that are happening as to why stuff like cryptocurrencies are going up in value. So which one would you invest in? Which one is the best one out of these three? Personally, this is the one I invest in because it's hedged. I want it to be able to track, or at least closely track, the price of Ether because I have very little faith in the Canadian dollar and I would rather not hold it in an American account. So that one is the one I personally hold. Now the management fee is 1.1%, which is quite high. You're getting closer to mutual fund territory, but we are talking about cryptocurrencies. There is a risk obviously involved, but there is a higher growth potential, but also when we're talking about that 1.1%, considering that, of course, it is cryptocurrency, there's probably a lot more manpower that goes into running this ETF than computer power, and because of that, they have to charge more money because humans want to get paid while computers don't care. The nice thing about it is they do pay a dividend every single month, and for those people who say that they were not going to, I would like to say that I was right. Anyways, so right now they're paying about 8 cents per share every single month. The month before was 8.3 cents, 10 cents there, 14 cents, and 5 cents. Now, why does this fluctuate so much? Well, the reason is because they're selling covered calls. They have the Bitcoin, and they're selling the option to buy that Bitcoin at a higher price at a future date. And if it doesn't hit that future price or that high price at a future date, then they keep their Bitcoin and they keep the premium for the option to buy those shares, those coins in the future. So that premium is paid out as a dividend. And there's a reason why it fluctuates is because the actual volatility of Bitcoin can change from month to month, which can also play into aspect of the price of covered calls. So because of that, that is why it fluctuates. Of course, if Bitcoin starts going through to the moon, I would assume that, of course, the price of the yield would also be improved or higher, but that's not always a guarantee. This is always good to know and understand, and not all covered call ETFs actually show this. However, these are the types of ETFs that I do like to see because, or at least invest in, because they tell you how many of the Ether, in this case, shares or coins, are currently being sold as covered calls. So about 17.23%. Now, what does this mean? Well, if Ether goes through the moon, to the moon, then most likely you will lose about 17% of your Ether coins in this ETF, which then means that you'll have fewer coins to make money on in the future until they start buying back in. They currently have 20 covered call options written, which is another nice fact to see, and you can also see how far out they are. So they are generally between less than a month to 3 months out. So they're not doing any crazy long covered calls. They're not going a year out or 2 years out. So you can kind of see the turnaround quickly enough to be able to get in and out and see where this ETF is going. Is it continuously going down because they keep on losing their coins through covered calls, or are they continuously being able to do them out of the money so that you don't have to worry about, of course, losing the coins if there's a 1 or 2 day fluctuation of craziness, which would be probably pretty smart. But either way, the level of yield that is in here, and it seems to pretty closely track the percentage of Ether, and same as the other one, BTCY. If you believe in cryptocurrencies, then this may be a good option to put some of your cryptocurrency fund into. That's just my thought. Now for BTCY, they do have a couple of different options as well. So they have BTCY, which is the one I invest in. Again, there's BTCYB, which is not hedged, which again, because I personally don't believe in our Canadian dollar, I personally believe in the American dollar more, so hedged is the way to go in my personal opinion. And there is also BTCYU, which is of course the one that is in American dollars. These have a 12%, 12.3 and 12.4% yield, while this one has a 15.6% yield. And I really want to break this down. So watch this. This is actually something that caught my mind anyways, and that is this ability for it to trade within a range. And every time it came down lower, it was at a higher point. That's when it hit that double bottom, and now it's broken past that level of resistance. This price of Bitcoin could actually continue to go higher. This is essentially what a lot of people were trying to look for. As soon as it reaches past that point, as we've seen, we now need to see where the next level of resistance is. And because, in my opinion, this was a direct line down, the only real resistance that we see is maybe at 50,000 potentially, maybe at 60,000 potentially, and then obviously at the top. If it can continue to break through these points, not too sure where the top is. We're going to have to see what happens in the world, because this is actually a good way to kind of hedge your money against inflation, at least in my own personal opinion. Again, same high management fee, and obviously the reason for that is going to be because there's probably a lot of manpower that gets put into these ETFs. Now the dividend on this one, BTCY, doesn't have as much of a fluctuation on the dividend every single month. It was 10 cents and then 10.85 cents, or sorry, 0.0785 cents, and then of course 0.075. So might as well say that you're somewhere in that 7.5 cent per share dividend. And again, because the shares of Bitcoin or the price of Bitcoin was going down, you generally, not always, but we'll see lesser volatility, at least when it comes to the call option market. And because of that, we're probably going to see a potential raise, in my opinion. I'm not going to say that it will happen in the future because, of course, today Bitcoin is up an ungodly amount of money. Now, the scary part is, of course, is the fact that they do have a 34.5% covered call strategy versus the whole 98%. Those are coming due over the next 3 months. 26 total options are written. So this is also a pretty interesting gauge as to where potentially this ETF may go. Moneyness is also very interesting, right? So really look at that and see where your risk tolerance is. When it comes to Bitcoin, it is risky. When it comes to Ethereum, it is risky. When it comes to cryptocurrency in general, it is more riskier than a regular investment. Obviously, anything with a ridiculously high dividend or yield also has a higher risk. We have to weigh that risk as to what we're comfortable with. So for example, myself at 31 years old, or close to 32 now, getting old, but at my age, I can put a little bit into risk. Because I'm young, I can make that money back. But going into the future, when I'm older, maybe not so much. I hope that you've enjoyed today's video. If you have, hit that like button, subscribe, and I'll see you guys again next time.